Something very unusual just happened in the silver market. And according to some analysts, the real move hasn't even started yet. What we just witnessed on Monday may have only been the setup, the calm before the storm, because if this theory is correct, Tuesday could bring one of the most violent price moves silver has seen in years. This is what some traders are now calling Turnaround Tuesday. And the reasoning behind it is not just technical, it's mechanical, it's structural, and it has everything to do with how the settlement system works. Let's break down what happened first. Because Monday's price action looked calm on the surface, but underneath, it may have been anything but normal. Silver closed Monday at 83,413. That number matters because it was above a key level that large institutional traders had been defending, but the real story happened at the open. In the first few minutes of trading, something extreme occurred. Over 14,000 contracts were dumped in just 6 minutes. Not gradually, not naturally, but almost instantly. That kind of speed and that kind of volume doesn't usually come from emotional retail traders. It looks more like algorithmic execution, a coordinated move designed to trigger panic, and it worked, at least temporarily. Prices dropped fast, stops were likely hit, and weaker hands were shaken out. But here's the twist. Shortly after that sell-off, a massive buy order appeared. Over 8,400 contracts were absorbed into the market, and that buying pressure stabilized the price. So what does that suggest? It suggests that while someone was trying to push prices down, another large player was more than willing to buy. That kind of action often signals underlying strength, not weakness. And this is where the idea of Turnaround Tuesday comes in, because this pattern has happened before. In several past market events, a quiet or manipulated Monday was followed by an explosive Tuesday. In 2008, gold saw a similar setup. Monday was uneventful, but Tuesday, prices surged dramatically. In 2020, silver experienced the same pattern. A calm Monday, followed by a powerful Tuesday rally. And even in 2013, palladium showed the same behavior. A quiet setup day, then a sudden spike. So the question becomes, why Tuesday? Why not Monday? Why not Wednesday? The answer lies in something most retail traders never think about: settlement mechanics. Specifically, a rule known as T+1, which simply means trade date plus 1 day. Here's how it works. If a bank or institution takes a large position on Monday, the financial obligations from that trade must be settled by Tuesday. That means if large players sold silver short on Monday, they must post margin by Tuesday morning. And not small amounts. We're talking about billions of dollars. Now imagine this scenario. A bank sells a massive amount of silver short. The price doesn't collapse the way they expected. Now Tuesday arrives, and they must post more cash. If they don't have enough liquidity, they only have two options. Option one, sell other assets to raise the cash, which can create ripple effects across multiple markets. Option two, buy back the silver and close the short position. And if many institutions do that at once, you get what traders call a short covering rally, or in extreme cases, a parabolic price spike. Some analysts even warn that this could trigger what's known as a gamma flip, where options-related buying accelerates the move even further. Now, let's step back, because there's another piece of this puzzle, and it has to do with the difference between the paper market and the physical market. In the futures market, there is something called open interest that represents how much silver is promised through contracts. Right now, some estimates suggest that open interest represents around 687 million ounces of silver, but the amount of registered physical silver actually available for delivery is only about 287 million ounces. That's a ratio of roughly 2.4 to 1, meaning there are far more paper promises than physical metal available. Now add another layer to this. Physical silver in retail markets is already trading at premiums. For example, some popular coins are selling nearly 8% above the official spot price. That suggests tight supply and strong demand in the real-world market. Meanwhile, some reports claim that registered inventory has been falling rapidly, down tens of millions of ounces in just a few weeks. If that trend continues, the pressure on the system could increase dramatically. And that brings us back to Tuesday, because if margin calls hit and banks are forced to act, the market could move fast, very fast. There are two main scenarios being discussed right now, and both involve extreme volatility. In part two, we'll break down those two possible outcomes, one involving a sudden flash crash, the other a violent upward spike, and why some analysts believe This isn't just about silver, but about a much bigger shift in the global financial system. So what exactly could happen on Tuesday? According to this analysis, there are two main scenarios, and both involve extreme volatility, not small moves, not slow trends, but sudden aggressive price action that could catch most traders completely off guard. Scenario 1, the flash crash. In this scenario, large institutions attempt one more aggressive move to push the price down. The timing would be critical. Some analysts point specifically to the 3 a.m. London Open, a period when liquidity is thinner and markets can move faster. Here's how the strategy would work. A sudden wave of selling hits the market. Prices drop sharply. Stop-loss orders get triggered. Retail traders panic, and weaker hands sell into the fear. This creates a cascade. Prices fall even further, and the market looks like it's collapsing. But then, after the stops are cleared and the panic selling is exhausted, the same large players start buying back their positions at lower prices. The result? A sharp reversal, a move that traps both sides, first the longs, then the shorts. To many traders, it would look chaotic, but to institutions, it would be a calculated reset, a way to reduce risk and improve their position before the next major move. Scenario 2, the capitulation spike. The second scenario is the complete opposite and potentially much more dramatic. In this case, banks and large institutions are unable to meet margin requirements. They can't post enough cash, they can't sell assets fast enough, and they're forced to buy back their short positions. But if multiple institutions try to cover shorts at the same time, and there may not be enough sellers, that's when price can go vertical. Not gradually, but suddenly. A wave of short covering, options-related buying, algorithmic reactions, all stacking on top of each other. Some analysts say this kind of move could push silver rapidly toward the $90 level or higher in a very short time. In extreme situations, exchanges can even halt trading or impose emergency rules if volatility becomes too intense. Now, whether either scenario happens, no one can say with certainty. But the key point is this: Tuesday isn't just another trading day, it's a settlement day. And that changes everything. Because the pressure isn't emotional, it's mechanical. It's built into the structure of the financial system itself. But for some analysts, this isn't just about a single trading session or a short squeeze. They see something much bigger happening. A long-term shift, a change in the monetary system. That has been building for decades, for over 50 years. The global financial system has revolved around fiat currencies, debt, and the petrodollar system. But today, debt levels are higher than ever. Central banks are accumulating gold, and confidence in paper currencies is being questioned. In this view, silver and gold are not just commodities. They're potential reset assets, tools that could be revalued to stabilize the financial system if a major crisis hits. And that's why some analysts believe the battle over silver prices is about much more than trading profits. It's about control, confidence, and the future of money itself. So what should investors actually do in a market like this? Many experienced traders repeat the same advice. If you hold physical silver, treat it as long-term insurance, not something to trade emotionally. If you're using leverage, be extremely cautious, because this kind of volatility can wipe out positions in hours. And if you're watching the market, pay close attention to key sessions, especially overnight trading, where major moves can begin before most people are even awake, because if Turnaround Tuesday lives up to its name, the next major move in silver could come fast and without warning. The real question is, will it be a final shakeout or the start of a powerful new rally? Only the market will decide, and we may not have to wait long to find out.